Imagine investing just $1,000 today and doing absolutely nothing for the next 30 years. No trading every day, no guessing which stock will explode, no expensive financial advisor, just one simple investment. Could that single decision eventually grow into tens of thousands of dollars or even more? For millions of Americans, the answer is yes. But here's the problem. Most beginners never start. Not because they don't have money, but because investing feels confusing. Words like stocks, ETFs, index funds, dividends, brokerage accounts sound complicated, so people keep waiting. I'll start next year. I'll invest when I make more money. I need to learn everything first. And while they're waiting, time quietly keeps moving. Why this matters? Here's a surprising fact. The biggest advantage in investing isn't having a lot of money. It's having time. Someone who starts investing at age 25 with just $1,000 often ends up far ahead of someone who starts with $10,000 at age 40. Because investing isn't just about money. It's about giving your money enough time to grow. Every year you delay, your future wealth becomes more expensive to build. That's why learning how to invest your first $1,000 could become one of the most important financial decisions you'll ever make. What is the S&P 500? So, where should beginners invest? Many experienced investors don't try to pick the next Apple or the next Tesla. Instead, they buy the entire market. This is where the S&P 500 comes in. The S&P 500 is an index containing around 500 of America's largest publicly traded companies. Names like Apple, Microsoft, Amazon, Nvidia, Meta, Costco, Visa, and hundreds of others. Instead of betting on one company, you're investing in many of America's biggest businesses at the same time. If one company struggles, others continue growing. That's what makes index investing so powerful. Index funds explained. But here's the important part. You don't buy the S&P 500 directly. Instead, you buy an index fund or an ETF that tracks it. Two of the most popular examples are VOO from Vanguard and SPY from State Street. Both are designed to follow the performance of the S&P 500. That means when America's biggest companies grow, your investment grows with them. No need to guess which company will win. No need to constantly buy and sell. You simply own a small piece of hundreds of successful businesses with one investment. So, you've decided to invest. Now what? The first step is surprisingly simple. You need a brokerage account. Think of it like a bank account, except instead of storing cash, it allows you to buy investments. In the United States, beginners often choose well-known brokers like Vanguard, Fidelity, Charles Schwab, or Robinhood. Opening an account usually takes only a few minutes. You'll provide your personal information, verify your identity, and connect your bank account. Once that's done, you're ready to invest. Step 2. Fund your account. Now comes the exciting part. Transfer your first $1,000. Don't worry if that's all you have. You don't need $50,000. You don't need $100,000. Every experienced investor started somewhere. The important thing isn't the amount. It's taking the first step. Because once your money enters the market, time finally starts working for you. Step 3. Choose an index fund. Now you'll search for an index fund. Many beginners choose funds that follow the S&P 500. For example, VOO or SPY. Both invest in hundreds of America's biggest companies. Instead of betting on one company, you're investing in the entire U.S. economy. That's why legendary investor Warren Buffett has repeatedly recommended low-cost S&P 500 index funds for most long-term investors. Not because they're exciting, but because they're simple, low-cost, and historically reliable over long periods. Don't try to time the market. Here's one mistake almost every beginner makes. They wait, hoping the market will fall. They think, I'll invest after the next crash. But nobody knows exactly when markets will rise or fall. Even professional investors struggle to predict short-term movements consistently. That's why experienced investors often repeat one simple idea. Time in the market is usually more important than timing the market. The sooner your money starts working, the longer it has to grow. Dollar cost averaging. There's another strategy that makes investing even easier. It's called dollar cost averaging, or DCA. Instead of investing a huge amount once, you invest a fixed amount regularly. Maybe $100 every month. Some months prices are higher, some months they're lower. Over time, this helps smooth out market ups and downs. It also removes emotion from investing. You don't need to guess. You simply stay consistent. Now imagine this. A few weeks after investing, the market suddenly drops. Your $1,000 becomes $950, then $920. For many beginners, this is the moment they panic. They think, I made a mistake. So they sell everything. But here's the truth. Market drops are completely normal. They've happened for decades. Every major crash in history eventually recovered. The investors who stayed patient were usually the ones rewarded the most. What successful investors do differently. Successful investors don't try to predict tomorrow. They focus on the next 10, 20, or even 30 years. Instead of asking, what will happen this week? They ask, will America's biggest companies still exist 20 years from now? History suggests they probably will. That's why long-term investing beats emotional investing. Keep investing consistently. The biggest secret isn't finding the perfect stock. It's staying consistent. Invest every month. Ignore short-term headlines. Let compound growth do the heavy lifting. Even small monthly investments can become surprisingly large over decades. Consistency almost always beats perfection. Common beginner mistakes. Let's quickly avoid a few expensive mistakes. Don't chase viral stocks. Don't buy because everyone on social media is talking about it. Don't panic during market crashes. Don't expect to get rich overnight. And most importantly, never invest money you'll need next month. Investing works best when you give your money time. Final message. Your first $1,000 probably won't make you rich, but it can change the way you think about money forever. Because the hardest investment isn't the second one, it's the first one. The moment you start, time becomes your greatest financial partner. The question isn't, is $1,000 enough to invest? The real question is, how much wealth are you losing every year you keep waiting? Your future doesn't change the day you become rich. It changes the day you decide to start.